WLSA2025 Leadership Summit 2025. We are here for our discussion on capitalizing on capital, the coming of age of domestic investors. Domestic capital is playing a critical role in the private investment sector, investing in funds, co-investing with them, partnering with them, and also occasionally stepping in their place. I'm delighted to introduce our session sponsors, Waterfield Advisors, an independent wealth advisory firm known for pioneering client-centric, fee-based wealth advisory for India's UHNIs and HNIs. Waterfield offers holistic wealth solutions including investment advisory in listed and unlisted markets, family office advisory, family governance, and more. Waterfield also pioneered the private market funds in India. I'm delighted to introduce our panel to discuss this momentum and what it means for the PEVC industry. Welcoming our moderator, Neeta Shivdasani, Managing Director, Client Origination and Coverage Head, Heritage Waterfield Advisors. Neeta is responsible for managing the development of global wealth clients as well as managing their portfolios. She's also in charge of spearheading the Heritage segment, a wealth advisory proposition exclusively for women, which has helped her gain expertise in HNI, UHNI advisory services. Her experience in portfolio construction, offshore advisory services, and relationship management has added tremendous value to Waterfield's proposition and offerings. Neha Patil, Kotle Patil Family Office. Neha Patil is the managing partner at ProGen Ventures and is an investor at Kotle Patil Family Office. She has done her Bachelor of Science from the University of Birmingham. She has also completed her Master of Science from the Imperial College of London. Rahul Khanna, managing partner of Trifecta. Rahul co-founded Trifecta Capital in 2014 and established it as a partner of choice for the financial needs of leading startups. He has 26 years of investing and operating experience across various sectors including in tech, media and telecom, and has spent his career working with technology startups and helping them scale both as an operator and as an investor. Rohan Paranjpe, Managing Director and Head of Alternative Investments at Waterfield Advisors. Rohan leads the team responsible for formulating portfolio strategies for clients in unlisted investments. In his role as managing partner for the Waterfield Fund of Funds, Rohan is responsible for leading and managing investments into VC and PE funds and co-investments with those funds. Shashi Singh, Chief Business Officer, Singularity Holdings, Madhukela Family Office. Prior to joining Singularity Holdings, Shashi spearheaded the sales strategy and business development initiatives at IIFL AMC. She has over 23 years of experience in the financial services industry across asset management and international business. She has worked across business development, channel partner engagement, distribution models, international business and sales strategy functions, maintaining distributor relationships. Over to you.
Thank you for the warm welcome. It's an absolute pleasure to welcome you all to this panel. The discussion on capitalizing on local capital, the coming age of domestic investors. Today we stand at an inflection point in India's investment landscape, one where domestic capital is stepping up as a formidable force in shaping the future of private equity and venture capital. Reflecting on this evolution, I'm reminded of the words of late Mr. Ratan Tata, who once said, "I have always been very confident and very upbeat about the future potential of India. I think it is a great country with great potential." The optimism is now mirrored in the actions of our domestic investors who are actively participating in the private equity and venture capital space. These are some of the questions we're going to explore over the next couple of minutes with our distinguished panelists who are here with us today, and we will hear insights from them. So my first question is for you, Rohan. The number of family offices in India has surged from 45 in 2018 to over 300 today, reflecting the rapid expansion of the wealth that has grown in Indian family offices. Could you share your observations on how Indian family offices have evolved in the last decade, particularly in their approach to the investing on the PE and the VC space and alternate investments?
First of all, thank you for having me here. It's a pleasure to be here. And Neeta, to answer your question, I think the journey's not been smooth, if I'm being very honest. You know, having been in venture capital and then now within Waterfield working closely with families, the trajectory has been that a lot of families started exploring this asset class in 2010, 2011. So, you know, it's been a while, but that was very early days. It was a new asset class in general. Some large families seeded some venture funds, which were the first few venture funds which started in the country in the equity side. Private equity has almost always been dominated by large global players, but in venture capital is when family offices first dip their toes. And since then, I think there has been an increase in excitement about the asset class, but it's not necessarily showed up in terms of returns. A lot of families first got disillusioned by VC funds, started doing direct investments. The way they started they would spend Saturdays with their angel networks, you know, cut 20-25 checks and hope that one of them works out. You may have heard of the success stories. There are a handful from that era, right? So for the most part, families did not have a great run at private markets. As the space has evolved, what we've started to see is that funds have become better and better at figuring out the landscape, the opportunities, and also pulling in a fair bit of capital and directing it the right way into the private markets. Certain families have bucked the trend, but they've taken very bold bets, very large bets, and have been consistent investors, but there's very few such families. And for the most part, all the families which started investing in the 2010-11 era have realized that it's better to trust the experts. So what I'm happy about right now is that there is an appreciation for and a recognition of what VC funds and PE funds bring to the table. At the same time, I also meet a lot of family offices who feel that they can do a great job in direct investments themselves. And my, argument to them is that if you're going to spend your entire day and build a portfolio of at least 20-25 companies, then maybe you might do a great job, right? Because effectively every really good fund, let's say early stages, the best fund in the country will do 25 investments per fund. They're doing 10 investments per year. So if they're so good, why don't they know which one's going to work out? Why do they need to do so many? Because that's how the space works. So if families want to do direct investment, they should do at least 20-25. But if you don't have that bandwidth, then making a claim, and that's how I see it, claiming that you can do a better job than people who are paid to do this and have been doing this for 10-15 years is a bit unreasonable. The best way to do it, according to us at Waterfield, is partner with the right fund managers and occasionally co-invest with them in some of their companies where they have a lot of say, they're on the board, they have far more insight into what's happening in that business compared to you. So I think, long answer short, it's not been an easy journey, but it's been marked with a level of maturity that has come into family offices who've been doing this for a while. I'm afraid for a lot of newer family offices jumping into the space and repeating the same mistakes.
It's going to be a tough fast.
They have to go through that journey. I guess that's what it is. Hopefully we'll make it smoother for them.
Thanks, Rohan. Neha, moving to you, being part of a family office, what motivates your family office to invest in the private equity and venture space? And are you primarily looking for capital appreciation, diversification, or any other strategic benefits?
So, hi everyone, and very excited to be here. I think a little different note as compared to what Rohan shared. So we started investing, and I would love to kind of share a couple of observations before I actually share the motivations behind investing. So if you see businesses are evolving at a very rapid pace. Agility has kind of become at the epicenter of the changes that we are seeing in day-to-day business environment. That also means, business families and businesses need to kind of stay updated with the know-hows about their own sector and the parallel sectors that they are kind of operating in. So our underlying motivation when we started investing was largely about the exponential growth curve that kind of comes in when you're interacting with founding teams on a day-to-day basis, right? Of course, there are those primary motivations which, including us, all family offices look for, and that is those superior returns that are generated through this asset class, right? And of course, I think apart from that, diversification of portfolio happens when you're investing in the private markets. But what I've seen largely is, I think, something that helps us a lot that we've started since we've started investing in the private markets is the growth curve and also the ability to kind of incorporate all those insights when we are interacting with the founders, looking at new age businesses into our own business and kind of integrating those mechanisms in our business, but at the same time having a little bit of a strategic partnership with founders where we are able to handhold them, also kind of help them scale up, help them kind of open our network, our set of partners, our set of clients for them. And I think it's a beautiful give and take relationship. So when he kind of when Rohan mentioned that it's kind of been a little bit rough for a couple of family offices. That's kind of given also because it's the nature of the asset class as such, and it's quite risky. But of course, there are multiple mechanisms in terms of how you can mitigate risks and stuff. A bit later on that, but I think our underlying motivation was actually to just see how new age businesses can also complement our existing traditional family business, and I think it's helped us wonderfully. We have also actually worked closely with a couple of founders and founding teams in terms of opening doors for them, opening our network for them. And I think family offices also bring in a lot of value in terms of hands-on operator-led experience, right? So when we are looking at prop tech deals, right, our team, and when I say our team, I'm not talking about key management personnel, but I'm actually talking about teams, that is our operational teams from the business, giving hands-on experience and hands-on feedback about new age prop tech companies, what they are launching, is it scalable, is it are the consumers going to take well to a product like that? So very recently, we were evaluating a prop tech company, excellent founders, IIT, incubated startup, great numbers, everything was a positive take, right? And our operations team said the two products that they want to kind of patent, right? We don't think it could be very long lasting because there could be other players who can maybe easily build on something similar. And that's where we kind of backed out of that investment. So those insights usually come from people who are running day-to-day businesses, and that's where I think the beauty of family offices kind of entering this space kind of comes in. So it also largely depends on how family offices want to take advantage of collaborating with new age companies, and how new age companies want want to partner with family offices, because I do feel that family offices also bring in a lot of strategic benefit. So defining that objective is essential, because a lot of family offices are doing maybe purely for returns, but I think along with returns comes a lot of other benefits, right? And that is tapping into your internal teams, helping founders open up your network, maybe eventually also CVC, that is corporate venture capital or corporate PE, where there are a lot of strategic acquisitions that are happening, and strategic plays where businesses can partner with new age companies for benefits for their own businesses. So I do feel that and the data speaks for it, right? I mean, there were I think 18 family offices, and now there are close to 300 with an AUM of around $30 billion being managed through that. So that's a substantial number, and I think that also means that there is a great access for new age companies to kind of look at domestic capital or capital from family offices, which is synonymously being known as patient capital, right? Unlike funds where there is a deep timeline in terms of getting the exits out, all of that, family offices can be great partners in terms of building that long-term trajectory. And of course family offices can build substantial wealth as well in that trajectory. Of course, the nuances of failure in terms of things not going right, monitoring, all of those are there. But I think over a period of time, when you get all things easier, and I think as compared to 2010, 2011, the access to information right now is tremendous, right? I mean, what we had before versus what we have in terms of access. There are times when I have access to the deal as much as a fund has access to the deal, because the founder thinks that there is equal value to be unlocked when a family office is coming on the cap table. So I do strongly feel that family office capital now is more like, I would say, smarter capital in the truest sense, because what insights an operator can give, I think maybe it could be skipped from research papers and due diligence documents from all these websites. But I think funds have been excellent partners for us in this process, as we
So
discussed.
you surely had a good experience.
I think more than good experience, I also feel how hands-on
Correct, yeah.
you are at the end of the day. I mean, I just kind of family values, and love to share this, but every dollar that you're putting in has to come back, or maybe more, right? So that mindset is essential, and because when it's family money, it's hard-earned capital, right?
Correct.
So you cannot be
And you're
like,
responsible for that.
I'm writing out 75% of my checks, right? It genuinely doesn't work like that. But yeah, I think that's been the journey so far, and I think it's a promising start and a journey for family offices in the coming decade.
Great, great. Thanks, Neha. Rahul, we've heard enough of equity, okay? So, Trifecta Capital has carved out a unique niche in providing venture debt to the Indian startups. What was your inspiration behind focusing on this space, and how would you differentiate yourselves from the traditional equity investors?
So first, thank you, Wimpy, for putting this event together. It's great to be in the minority in this room. Usually it's the other way around, so it's great to be here. So I've been in venture capital and the world of tech for about 30 years now. The first 10 years of that, when I came back to India, was in venture capital. And so from '05 to roughly 2014, saw the build out of the venture capital industry and played some small role in what happened there. We then sold our India portfolio to one of our LPs, and I was at a bit of a crossroads because I could have gone and joined one more fund or decided to go build an independent platform, and that was the choice. And the next question was, look, can you build a better Sequoia? Can you build a better Axel? Can you build a better Lightspeed? Or do you go build something else, right? And that something else, came out of just the development of the market, because as the venture equity market was growing, there was a companion asset class of venture debt that hadn't emerged in India. And having spent some time in the Valley and having seen the role of venture debt and venture equity as sort of companion products, we felt that there was an opportunity to build the asset class. Building on Neha's point, the supply side of capital was actually not that excited about pure equity investing, partly because they didn't like losing money, partly because they didn't like the binary nature of a lot of venture investments, 0 or 1. And then, most importantly, I think they've not been happy with the long hold periods and the lack of liquidity from the equity asset class. So the supply side had a certain set of challenges that they were dealing with. And the demand side, which is companies that were growing quickly, were looking for non-dilutive growth financing. And they were funding inventory and working capital, deposits and capex with very expensive equity. So the founders were talking to us and saying, look, we need a better form of financing that doesn't dilute us entirely. And the LP community was saying, look, we'd love to play in the venture asset class, but we just don't like this pure equity product. So what we ended up doing was sort of finding that product market fit, which is the supply of capital was looking for more predictable returns, shorter duration, maybe leaving some upside on the table, but with a certainty of getting money back. And founders just love the idea of being able to raise more capital. Our first fund was raised entirely with rupee capital. I will say that to bring legitimacy to what we did, we actually first went to institutions. I remember sitting down with an Uday Kotak and a Deepak Parekh and Arundhati Bhattacharya, and they all said, look, we know venture, we know debt. What the hell is venture debt? And so I just said, look, I promise you I won't lose any money. And so, fast forward to today, we've invested about 7,000 crores across order of magnitude about 200 companies on the venture debt side. We've had multiple funds, and happy to share that the plot generally has worked out well. And then, of course, over the years, we ended up building relationships with a lot of families that had a similar perspective, which is we want to actually learn and engage. And because venture debt is a much broader portfolio, we end up accessing many different verticals: healthcare, education, transport, food, energy, etc. And our LPs are dominant in those sectors. And so when we sit down with them and do a quarterly meeting, it's not about the fund performance, it's, hey, which are the 3 or 4 most interesting companies that I should be looking at? And then how can I get access to either their cap table, or can we start to do business with them? So I think the families are looking for that alpha in terms of access and knowledge. And I think our institution investors, banks, insurance companies, endowments are looking for very range-bound, predictable returns with limited volatility.
What would your percentage be on the domestic side on this?
Yeah, we're at maybe 80+%
Oh,
of
wow.
rupee capital.
Okay.
So yeah, we've had to really carry the flag for fundraising in India.
Okay.
And we've also had to do a lot of it on our own because candidly the asset class didn't exist. And I'd never done a deal of debt before starting Trifecta Capital. So yeah, there was a lot of unknowns there.
Great, great. Thank you. Shashi, moving to you. Family offices are increasingly investing in startups across various sectors like green energy, chip technology, robotics, aiming for higher returns, obviously. What are the primary factors that drive family offices to choose between investing through established PEVC funds versus engaging in direct deals with startups?
Hi everyone, and we've had Rohan talk about his perspective on how family offices should approach on investing, and we've had Neha who's had her views. We are a family office as well as a fund house which manages money for family offices. I would say, if your objective is clear, like what Neha said, and what are you trying to drive? Primarily, for a family office, it is very difficult to have a complete setup, to do research, to get transactions access, and then to monitor them continuously, which is the main part when you invest in a private company. It is essential that you monitor, and lastly, to support these founders to scale up the way they have envisioned. Because for a startup, there are multiple stages, and at each stage, they will find different things that they have to cover to scale up to the level that they want to. Early stage and growth stage is the 2 stages I would like to differentiate. Will not say late stage is anything like a private investment, but early stage, too many transactions available. Every new investment that we see, we find a great idea, but to be able to see and witness whether this is a scalable idea, how long this will go, because we've seen most of the early stage companies will fall off towards the growth stage. So that support, that mentoring which is required for these founders, if a family office is able to provide that strategic guidance, or it is strategically aligned with their business, then great, one should go, because they have more insights in that field or in that sector. But if the family office is out there just to invest directly because they want to optimize on the cost, I would say they should spend a lot of time in selecting the right managers which meets their objective of allocating capital across private firms, whether it's sectors, stages, or what. Because you need, as Rohan mentioned, you need that much time to be spent and that many people to do that work if you're investing in private companies. Unlike in a listed company, a lot of data is available and research is available. So I would say, while we meet a lot of family offices and obviously we do only growth to late stage investments, there are a few family offices which are very clear, which are only investing firms, and they're like a mini fund house themselves. Then rightfully so, they can do investments directly. They still align with good managers and do co-investments and team up with them for investments, because it's always good to have 2-3 people doing the research and the monitoring of a company along with you. But there are family offices who are like 2 member, 4 member team and trying to do direct investments. There, I would say the failure rate could be far higher unless and until it's a very strategic initiative. Like there are some family offices which have a clear objective that they'll invest only in the sector that they are present in. Then they have a lot of expertise and experience of that sector. They can mentor and guide the founder as well as not make a mistake on that investment or the valuation. But apart from that, if you are just trying to optimize the cost and invest directly and not through a fund, I would say no. But larger family offices that I meet normally take the route of going with the fund and trying to do a lot of co-investments to build the book behind a fund, which is a larger book.
Thank you, Jashi. Rahul, talking about trends, how do you view the rise of AI, fintech, and other tech-driven sectors in India? Are there any specific trends or technologies that you're particularly excited about?
Yeah, is any business not an AI business anymore? So I met a company yesterday that was called like Sprouts.ai. So it's like, growing veggies with an AI perspective. No, actually they're a software company and doing interesting stuff. Look, we are not a thematic fund, and part of doing venture debt is to be highly diversified and don't get too carried away with any one particular sector. So we tend to follow sort of sectors that are reaching early maturity. I'd say with each vintage of our funds, there was a time when there was a lot of excitement about vertical commerce, fintech, edtech, agri-tech. So we've seen these cycles come and go. I do feel like a lot of energy went into serving what people call India One, and I call it solving rich man's problems or rich women's problems, and problems of convenience. I think we're moving into an era of solving for access, and I think there are some big problems around healthcare, including now education, transport, food, energy. These are really big challenges for India. I think the VC community is also starting to think more deeply about core tech. We're no longer just thinking about business model innovation. And we're also recognizing that AI is a platform shift that allows a whole new generation of companies to be built for the world. And I think the DeepSeek moment happened that reminded everyone that, look, you can create a lot of value even if you don't build your own LLM. So I'd say that there is a fair amount of opportunity. But like everything else in India, I do feel like, money comes in waves. And right now, sort of anything that has an AI attached to it is able to raise capital, which then generally tends to disappoint a little bit later. So I think thematically, lots of opportunity in serving kind of India too, and just figuring out how to do that at scale.
Thanks. Coming back to family offices, Rohan. In 2024 alone, family offices contributed $9.6 billion to venture capital investments in Indian startups, accounting for a substantial portion of the 23.7 billion, which is almost about 40%. How would Waterfield Advisors, as a multi-family office, view this? And are Indian family offices emerging as the key to unlocking domestic capital?
So I think the short answer is yes, right? It is what I've noticed now, 6 years working with family offices, 10 plus in the venture space. When the public markets are doing really well, everybody is risk on, everybody wants to do privates, right? And this was a strange era in privates when the publics were at all-time highs, but the private markets were still relatively subdued. So it was a great time to invest, and I'm happy that family offices did. When the publics are flat, I don't know if the same level of enthusiasm remains. Now, we do need to peel the onion on some of these numbers, right? How much of it was, for example, let's say NSE, which is a great, one-of-one trade that family offices love, fund will never do. It's fantastic. How much of it was the pre-IPO stuff, right? We saw a lot of interest into Swiggy. Again, not a bad investment at all, but also very driven by momentum. Public markets are doing well, this one's going to go public, there's a gap in valuations, let's do it. So I think we have to wait and see whether this trend continues. It is a function of public markets, but overall definitely more capital going into private markets, which is great. But now we're seeing more specialized private market investments from specific family offices, which is getting me very excited. In that, they're, you know, funds can be great, but they're not perfect. And there's a lot of funds who have made a lot of mistakes driven by their structures, their requirements, their incentives, you name it. One of the, I think, big issues with funds, at least at later stages, is that they, whenever they invest in a company, they prefer to kick the can down the road in terms of going public. If a large institution comes into a large profitable business, they'll say, why do you want to go public now? Wait 5 years. Let's increase your revenues to this number, margins to this number, and then we'll go public, right? But it's never that easy. But family offices don't have that issue. They'll get into a quality business which is, you know, profitable, great margins, one of one in their space, and they'll say, let's take you public today. And that's not a bad thing at all. And some of those opportunities we're seeing, good companies which are not going to be massive outcomes and so are not attracting institutional capital, but can still be great public outcomes, and families recognize that, and because of their flexibility, they're saying, I can sit on this for a year, 2 years, and then take it public, and then I'll take my own decision after that. That's something I'm very excited about. I think it gives a lot of high quality but mid-sized startups in the country an avenue to exit. A little bit of capital and a little bit of push, and that support to say, you know, go public today or go public next year. Instead of trying to speak to those same few, you know, 15, 20 large institutions who see every deal in the growth space but are only interested in $10 billion outcomes. Instead, we can see $1 billion, $2 billion outcomes on the public market. So I think the trend is great. It should continue. I think it will be a bit subdued this year. That's my guess. There are pockets of opportunity which are ideally suited for families, and families are recognizing that. I'm excited about it. And again, a word of caution, because it's not all roses and rainbows. There will be opportunities like a Zepto, which a lot of families have jumped into. A large chunk of that start was probably going to be money to Zepto. That's very, very risky. I don't want to make a comment on yes or no, but it's not a done deal. And if it works out, I think we'll see more money coming from families into the space. If it doesn't work out, I think we'll see families pull back. So, you know what, it's not worth it. So let's see. But at least at Waterfield, we're trying to nudge people towards safer outcomes as of now, till families are very comfortable taking on that risk and building a portfolio.
So for the audience here, I just had one question. Is, you know, how does one choose the right fund? So, you know, when you're taking a call on that you want to invest in this asset class, so how would somebody out here, say for example, they want to go into this asset class, how would they choose on which is the right fund? Or is there another, you know, platform that one can use to, you know, invest in this private space?
First, you look for Rahul Khanna and then you just invest in his fund. But if you can't, I think the challenge for families investing into funds, there's a couple of challenges, right? I think the good funds in India, on the equity side, not on the debt side, but on the equity side, have always preferred international capital because it's stickier, long-term, large checks, few questions. And so the best funds are always oversubscribed by international investors. And so you're left with a lot of funds who either actively prioritize raising family office capital or are unable to raise international capital. How do you distinguish between the two? It's a tough task. It's not easy. And you're really betting on the potential of that fund, right? Even if you do have a special relationship with a quality fund manager who says, you know what, I'm oversubscribed, but I'll make space for you. The challenge is that you're still a small passive investor in a very large vehicle where you're not really going to get access to that fund. You're not really going to get too much information about that portfolio. You're not going to get co-investment opportunities. So one of the things we try to solve for with the fund of funds is that can we allow everybody who doesn't want to jump in head first into private markets, but maybe start small, still get exposure to the best fund in the country by creating a platform where we become large investors in those funds. And so then the funds appreciate, they look at us the same way that they would look at an international institution, right? And for an investor into our fund of funds, that check whatever it may be, 2, 3, 5 crores, 10 crores, and or 100, the portfolio is the same, and it's the same portfolio across, early stage quality equity funds all the way to growth stage. And because we're large investors in these funds, we get co-investments, we get all the information, and we're able to help families connect with the right individuals within these good funds for anything outside of just financial returns. Hinting at what Neha referred to, I think if families want to learn more about what's happening in their operating space, are there interesting startups that have come about? Is there any disruption that we should be aware of? How do you get in touch with those companies? A lot of times you may know a fund manager, you might speak to them, but that individual may not look at that space. And so everybody in the VC space can talk big game, but do they really know what they're talking about that specific sector? Who knows? And that's where we come in. We know which partner and which fund is looking at which sector. So there's a lot of benefits to extract, intangible benefits to extract also from the platform. Of course, the platform helps you get access to some quality funds. Not that that's the only way to do it. I tell all families, it's not a silver bullet. It's not the only investment you'll make. It's one portion of your private market portfolio. The rest is very specific.
Sure. Thanks, Rohan. Coming to a bit of question on diversity. Shashi, this is for you. Have you observed a rise in women family members taking active participation in financial decisions, and especially on the PE/VC space? I mean, we have Neha here, but do you see a lot of family offices where you have women who are taking active interest in this asset class?
It's a tough question to answer, but I would say no. Though my wish is that I meet more and more women from the family in the investment decisions or taking active part in the business, but the social institution is such that we still don't have a lot of women in the family coming actively in the business, and the second stage is coming on the investment side. So the answer is no, but I would look at it the other way also, that ground up there's a lot of work to be done to help women get into this field. And like Rahul mentioned, we have so many challenges to tackle in India: food, nutrition, healthcare. I think one of the challenges to tackle is to how to get more and more women to get excited that they take the initiative to rise up and come into the investment world. I wouldn't say there's any discrimination when you enter the field. I've been now 31 years in this industry and never felt that I was a woman or I'm dealing with men, though I was always not a minority, the only one in the whole team. But women will have to take the initiative to come in. We have very few women in the industry itself. Unlike, say, a fashion industry or a consumer industry, investments we find very less women who have been here. And the same is the case from the family office sides. You find most of the financial decisions taken by the men in the family, and that needs to break. Just like Neha from the family is now taken this initiative, I feel
No,
more
but
and more
I would
Neha
love
should
to
come in.
intervene. Actually, it's not through the family. I always was passionate about venture,
Yes.
and organically it happened so that during COVID times the family office became active, and I also do independent bets. But then that's how I kind of
Yeah,
collaborated and
That's
became a
what
part
women
of it.
have
So
to first initiative is from within, that you want to do it, and then the family. So we can't blame that the family is not letting women come in, but maybe women are not taking the initiative to come into this.
Thanks, Shashi. Neha, this question's for you. What strategies do family offices employ to manage the risk associated with direct startup investments? Because you were mentioning that you have a few. And how do you balance these risks with the potential for high returns?
So, there's just one term I think that has worked excellently, and that's collaboration and getting the right people on board very early on. Um, doesn't matter if you're doing direct investments or you're investing through funds, but the best way to mitigate risk is actually collaborating in all directions very early on. That means, having the right co-investors on board, having the right domain experts on board, having the right legal partners on board, having the right finance partners on board. Of course, there are those typical strategies where you have to do thorough due diligence and you have to make sure that internal governance frameworks are in place. All of that, of course, it exists, but I think the strong indicator for I think success in this space largely is around collaboration, and that essentially is about who are your partners very early on. Just the way startup founders or just company founders need right partners to kind of grow, family offices need to have right partners on board. So if you're doing independent deals, then have sectoral or domain experts on board who you're co-investing with. If you are kind of investing in your own space, then try and have funds who are relevant in that space co-investing with you or leading those transactions, because I just feel that gives broader insights into the companies that you're investing in, the space that you're investing in, and that's how you're kind of mitigating the risk. Because I don't think it is possible for all. I would say like for very few family offices, it's possible to kind of create fantastic teams in house. Otherwise, it's not possible to create really strong teams in house. And to kind of make up for that, and if you genuinely want to do independent deals, then I think the best way is collaboration. That is one. And otherwise, as Rohan mentioned, there are fantastic fund managers who are experts of their sectors, who've been around for a while, and who kind of know what they are doing. Then the other way is just go and kind of collaborate with them or invest in their fund. And now I think almost every fund, I mean, also of course depends on your check size, do allow for co-investment strategies. So where you kind of participate in the fund and then you do co-investments with the fund wherever you feel there is a strategic interest in a deal, or wherever you feel you want to top up in a certain company. Then I think that's the ideal way to go about things. Of course, then there are other tools like having a good governance mechanism, because you cannot write a check and just forget about it. You have to kind of constantly monitor what the founders are up to, set your own parameters in house, that what is it that you're actually looking out for in a certain company as it grows, right? Because so many sectors, so many companies, having your own parameters, templatizing those is essential as your portfolio grows. So I think fundamentally the key word and I think key term is collaboration, and I think other people can comment on it, but if you all agree, then
Sure.
I think that's what I feel.
Thanks, thanks. So actually, I had two questions which were for all the panelists, but I think we were pressed on time, so I'll just ask one question. What advice? I mean, and it can be as brief as it can be. What advice would you offer to emerging family offices who have not yet invested in this alternate asset class, which is PVC? How would you want them to enter this space? So just a few words, one or two words.
I can start off, and I have only one line to say: spend a lot of time in selecting a good manager, get a good advisor like Waterfield, and don't go direct first. Take your time to go direct.
Checks in the mail. But similar, I think stay the course, start small, learn from everybody else, and don't get disheartened. It's a long journey.
Yeah, I'd say start, but pace yourself. The private markets are only going to grow, but it's important to have a toe at least in there, and then as the markets evolve, you can grow exposure.
Yeah, I think selecting the right fund manager, that's all that is to it.
Great, great. Thank you so much, everybody. Thank you for your insights. Any questions from the audience or?
Yeah, sure. So, since we're talking about family offices, Neha, this question is specifically for you. What we've seen, at least in the US, is that family offices typically tend to, or very high net worth investors, tend to allocate a lot, given the return profile in the US, of course, to the alternative space, what are we seeing in India in terms of percentages of allocation?
Not substantial, very honestly, not substantial. Also, everyone is, I think, just testing waters, because if you see, the number of family offices have increased substantially now in recent years. So I think there's still a long way to go where, family offices, or just ultra HNIs, are embracing this asset class openly. What I do see though is there are a lot of these new age founders who've got exits, right? They are going out, they are either co-launching a fund. So for example, Singularity, right? They've got a Amish Anand on board, who's got an exit from Carrot Lane. There is Mithun Sancheti on board, who's also got a fantastic exit, right? Now these are the people who understand new age businesses well. They've done that, they've built it out, and then they are happy to take larger bets, right? You also see a lot of these, founders either creating their own funds, family offices. So that's where I think they are the ones who are taking larger bets. But I think the ones who've been around for a while, I think there's still a little time. Yeah.
If I may just add to that, sorry, and I'll make it quick, because we see a lot of portfolios across family offices, right? I think the source of wealth matters, something that Neha alluded to. If you have generated your wealth by being funded the private markets and found an exit, you are a lot more comfortable with investing in privates, and we see portfolios as high as 50% in private markets, right, and 50 in public. If this is something you're starting for the first time, let's say you're a patriarch of a listed company, you've not sort of, dealt with this asset class at all, it's going to be 1 to 5%. If you're the second generation, a lot younger, willing to take risk, and has been exposed to this asset class since their early 20s, mid 20s, 30-35%. So it depends, but this is what we noticed.
Thank you. You can continue your conversations over lunch. We'll all be there. Sorry. We request the panelists to to stay back for our token of appreciation. Hi. So we have Pawan Chaturvedi with us, partner and head Asia at Unilever Ventures.